Well, hello, everybody. Houston, do we have a problem? So, kind of some interesting results this week. And one of the things that's tough when you're looking at the market statistics is trying to understand, am I misreading something in these that's the result of a holiday or something else that might affect data? Or is this a general trend line that we're seeing? So, let's go ahead and get started. My name is Stephen Meade with Domicile real estate for people who love houses. And, we're going to do our typical format, but I'm going to go back to something that we were doing a couple months ago. And I'm going to give a couple minutes on, given this information, what should you be doing or considering if you're a buyer, and what should you be doing or considering if you are a seller. So let's go ahead and jump into the market stats. Okay. So the first thing we're going to look at is these total active listings, and I think this really is telling a bit of a story. So where are we at here? Let's just use this as a reference point for last year. We've really broken new ground on total actives under a million and total actives between 1 and 2 million, right? So if we just look at the raw numbers here, and just as a reminder, everybody, this is LA and Orange counties. We're at 6,000 active listings under $1 million, whereas last year on this time we were a little over 4,000. So that's almost a 50% increase. Things are a little bit easier over here on that 1 to 2 million category, right? Like here we are at maybe like, gosh, probably like 4,300 versus 3,000. So not quite as big of a jump as a percentage, but still heading up there in that 1 to $2 million category. So I mean, this is pretty obvious, right? Like this is actual active listings on the market. I do have a little bit of a theory on that. I think that these are not necessarily all motivated sellers. I think if you go on the market at a ridiculous price, just hoping somebody will buy your house, that doesn't really make you a motivated seller. So I think there might be a little bit of skewing on that. I also think we might have a little bit going on because of that July 4th weekend, right? Like people hold off putting their house in the market, and then as soon as that week ends, they all jump to the next week. But with that said, I mean, you look, it's a pretty steady upward graph if you're looking at that. So I don't think that's a huge factor, at least not in this one. If we look at our new listings, in fact, we actually see a little bit of the opposite. In the last 2 weeks, new listings are actually going down versus kind of this upper little plateau that they've been on. And that's both for under a million and 1 to 2 million. So new listings are going down, and yet active inventory is going up. There's only one sort of plausible explanation, and that is that new escrows are taking a dive. And I've been kind of trying to go through this, really thinking about what could be causing this, right? Like what kind of things do we see going on that could explain this? And I think a lot of this is related to the difference, right, of this year versus last year. So if you look here versus last year, where are we at? We are at approximately the same level in 1 to $2 million new escrows as we were at last year, right? Almost about the same level. The difference is we just have a lot more active inventory on the market than we did last year. And if we looked at those new listings, we have more listings coming online as we do last year. But if we look under $1 million, we have way fewer contracts. Now, admittedly, part of this might be that there aren't quite as many, under 1 million buyers maybe, but I don't really buy that. I think this is a real decrease. And I think the explanation here is, what group of people do you think is more affected by interest rate volatility? Do you think it is the people buying in the 1 to $2 million category, or do you think it's the people that are buying under $1 million? And I think it's the latter. I think it's that under $1 million group. These are the buyers that really are kind of on this a bit of a whipsaw character. And so we're actually seeing them be below we were at last year. I think there's a lot of fatigue, and their affordability is down, right? Prices are higher this year than they were last year, and yet interest rates are approximately the same. I think that's really a recipe for just fewer buyers are in that affordability camp, whereas the people in 1 to 2 million, maybe they're people transferring, they're people coming in with equity, they already have better jobs. I think that those fluctuations mean less for that group of people. So if we look at our absorption rate, right, that is kind of an interesting one. we are way down versus last year where we were at this point. And what does that mean? That just means on the raw numbers, versus the homes coming onto the market versus the homes going off the market, there's definitely a little bit more of an imbalance. I would call this close to an even market. And there is some question, is this skewed a little bit by the holiday? I mean, it's possible, but that it's not like we're measuring a rush of new listings coming in. I think this is really being driven by a lack of purchases. And I think if you're talking about a lack of purchases, right, then that question becomes, is it people aren't purchasing because demand is down, because people can't, there aren't as many buyers in the marketplace, or is it because these buyers are pickier, meaning it's the same number of buyers, but their expectations are higher, and maybe they're less likely to write offers than they were in the past? I think it's probably a combination, but I think that latter factor, that buyers are pickier. They're saying at these prices, at these interest rates, I really want to be in love with the house that I'm buying. So I think they are looking through the inventory, and it's kind of like the thrift store, right? Like they're just speeding through the racks of clothes looking for that hidden gem. I think that's where the buyers are at. And really, that's going to be a clue, I think, in strategy for sellers. So if you look at our close prices, this also tells us something else. And admittedly, as always, the caveat here is that this data is, 45 days old. But if you look at this, that upper end of the market, I mean, look how steady that number is, right? I mean, that is flat. But if you look at our median and our entry level end of the market, well, these are experiencing a little bit of, a small amount, right, of price retrenchment. So what does that mean? Again, that tells us those buyers in that upper price range, that market is just a little bit healthier from a maintaining prices standpoint versus the lower end of the market. If we look at our still active after 14 days on market, again, this number has shot up. It is definitely above where it was at last year. And, really one of the things about this is this predicts future inventory. So if you see this number going up, it means there's going to be more inventory in the future. And I think a big part of that, is again, that sort of, we've got lots of inventory, but I don't know if it's the inventory that today's buyers want. I don't know if they are realistic sellers, right? Like buyers are like, great, there's more inventory. I don't like any of these things. And so I think that might be a little bit of a factor. Whereas before, I think buyers might have had that mentality across the entire price spectrum. I'm happy to get a house. I'm happy to get my offer accepted. Now buyers have shifted to, gosh, houses are expensive and interest rates are high. I'm only going to do this if it's a house I really like. And that's a very different buyer mentality. List to close ratio, though, look at that. We're not seeing a huge drop in prices. So what is that telling us? We're not seeing a huge drop in prices or in sort of that measurable difference between buyers and sellers. But there's something interesting about this data. This data is very, very skewed, and it's skewed in a certain way of purpose. And that is, this data is only skewed for the prices of homes that are selling, not the ones that are sitting on the market, right? And that should give us a really big clue, because there really is kind of the haves and the have-nots in this market. There's a market difference in the environment for the homes that people want and are going under contract, and those that are sitting for 15, 30, 30 days or even more. There is very much a haves and have-nots, upside down world and right side up world. There's definitely a dividing line right now that we really haven't seen in this market. So when we're tracking these stats, there's a big difference between the things that are active and the things that are actually selling. So if we look at our days on market for new contracts, this is going up a little bit, but it's really hard to call 32 days, 33 days a long time on the market. So, this is heading up, but I don't know if I'm necessarily ready to draw some big conclusions from this. If we look at our three-way chart, right, I think that might give us maybe a little bit more of a clue, too, of what's happening. Is you'll notice we saw kind of a bit of a drop in the rents. Did it retrench all the way to where it was back in the earlier spring? No, but it's retrenched a little bit, which I think is interesting. That might mean some of those buyers who are kind of facing that do I rent or do I buy scenario, maybe they're going to be more likely to find that rental house, and they're going to be out of the buying marketplace. So I think we might be seeing a little bit of that effect. And we're also seeing that payment index. Gosh, whenever this gap grows too big, that should really tell you something. When that payment gap gets too large, I think that's when you start to see us kind of push on that affordability limit. And if we look at our prevailing mortgage rates, this doesn't entirely, we take this is based on a Freddie Mac once a week index. I don't think this entirely reflects some of the recent market movement in a favorable direction for buyers. So I do think we're going to see a little bit of bump in activity over in the next 2 weeks when we revisit this, primarily because that under $1 million market is so subject to kind of those rate fluctuations. So now we're going to talk about if you are a buyer, if you are a seller, like what really should you be thinking? I think if you're a seller, right, and there's a tale of two kinds of listings, the ones that are selling and maintaining prices and the ones that are not, which group do you want to be in? Now is not the time to test a crazy high list price. Now is not the time in this market either to kind of just throw your house up and see what happens. You really have to have a deliberate launch strategy. That's what we're telling all of our clients. You want to make the most desirable product that you can because you really want to be in that category of listings that's getting noticed, not in that category of listings that are sitting. Now, if you're a buyer, guess what? Your advice is the opposite. You want to look for those sellers who didn't prep their listings. You want to look for those homes that are getting stale on the market where maybe the seller's beginning to panic. You want to be in that intersection. If you are a deal shopper, you want to be in the intersection of a buyer who is mispriced or a seller who is mispriced and a seller who needs to sell, right? Someone who did not position their house correctly and really doesn't have a choice on selling. Maybe they have a job relocation. Maybe it's a property where they're selling for a relative who's gone to assisted living or passed away. These are the kind of properties where if they're mispriced or mispresented, you're going to find the best deals. I also think, as always, my advice, especially to my architectural clients, is, 20 years from now, 10 years from now, even 5 years from now, you're not going to care that you paid $10,000 more than maybe you think you should have, or even 20, or probably even 30 for a house that you really wanted, right? I think whenever we are facing any kind of market uncertainty, I will say you are always way better off being in a house you really like. That's just the way it is. So even if you're a deal shopper, be careful, right? Don't fall in love with the deal if you hate the house. And I think that's a really common mistake a lot of people make. Anyhow, thanks so much for watching. Questions and comments, we love them. Don't forget to like, subscribe, and hit that notification bell. And once again, if you are looking to buy or sell real estate here in Southern California, definitely reach out to us. Our contact information is down below in the description. We would love to hear from you. We will see you again real soon.